Hi, welcome. It's Mary Ellen McGonagle, Senior Managing Director of Equities here at Simpler Trading with your Weekly Edge show for Friday, February 24th. Today, as usual, we are going to take a look at where the broader markets closed for the week. We are at somewhat critical levels that you'll want to be aware of, and then also take a look beyond the markets and see where there may be rotation shaping up given the recent weakness. Also, we'll take a look at some of those headline news that drove price action last week. You want to be aware of what is pushing these markets around, primarily so that you can prepare yourself going forward. And then last up, viewer question of the week, and it's all about how you can buffer your long equity portfolio by sprinkling in some defensive stocks. So I have three names that I will be sharing with you today. So from here, let's go ahead and take a look at some of that news from last week. First up, most impactful, certainly on the lookout for, but however it was not impactful, were the notes from the Federal Reserve's latest meeting. And those notes that were released on Wednesday really did not have a lot in the way of surprises. The information that was released continued to mention that high inflation is an issue and it's anticipated to remain an issue for a while. However, the rate of increases in interest rates was mixed, so that the anticipation at the Federal Reserve's next meeting is that it will be 0.25%, which is what it was prior to the release of those notes. Also, last week we did get GDP numbers for that fourth quarter, the first revision, and it was revised lower. Originally, good news. We are in that period where reduced growth is generally viewed as a positive. The Federal Reserve wants to keep economic and growth elsewhere really muted until we get inflation out of the way. Also, we did receive weekly jobless claims on Thursday, and they remain low. This is a sticking point as well for the Federal Reserve because they want to see those jobless claims rise and unemployment to increase as well, all with an eye toward helping to reduce inflation. Also, January core PCE, and this is a very big number. It's that personal consumption expenditures number that's very closely watched by the Federal Reserve. It's their number one gauge of inflation, and it did see the biggest rise in 6 months, and that took place today on Friday, and the markets did sell off fairly steeply in response. Also, we did see consumer sentiment as well as consumer spending both pick up, not tremendously, but again, another metric that is going in the wrong direction because increased spending is what is going to keep inflation elevated and then in turn keep the Federal Reserve on a path to continue to raise rates, which is not good for the markets. Next week, we will receive a whole lot of Federal Reserve officials, and by that I mean 5 different officials are due to speak next week, but also the economic calendar is very light. The relevance there is that oftentimes when that's the case, there'll be much more weight given to any Federal Reserve comments that may be released, so we could be in for a volatile period next week. So from here, let's go ahead and take a look at those markets and where did we close the week. And first up here is a daily price chart of the S&P 500 and a couple of very impactful items that took place last week. And first up is the fact that RSI, that's a relative strength momentum indicator, and it did break below that 50 and is now trending downward. Faster moving momentum indicator, stochastics, also now below 50 and trending lower. So we do now have negative momentum taking place in the broader S&P 500. And then also this index closed the week below this red 50-day simple moving average. Just a little, but it certainly is below. That is rather impactful because it's very closely watched by certainly institutional investors and the broader markets. That 50-day tends to be that line in the sand. Ideally, we would want the S&P 500 to regain at least that 50-day. And then as you're looking for other upside potential resistance, it will be this green 10-day simple moving average and this purple 21-day simple moving average. Your next area of support here is that 200-day blue line here, and we are awfully close to potentially breaking below that. But net, we do have negative momentum, which is not constructive. From here, we're going to take a quick look at the NASDAQ. It was down a bit more than the S&P 500. And we can see that it too has negative momentum with that RSI below 50 trending lower. Likewise with the stochastics, another faster moving momentum indicator below 50 trending lower. And let's take a look. You can see that the NASDAQ closed right at that 200-day simple moving average and just a hair below. And this is another key metric for the broader markets and institutional investors. The 250 are both very closely watched, so not particularly good, particularly also given negative momentum that is currently taking shape. So the broader markets are not in a healthy condition at this point in time. From here, let's go ahead and take this a little bit further. We're going to take a look at the 11 underlying sectors within the S&P 500. This is a two-month daily price chart view. I've gone ahead and added an RSI. That's your relative strength indicator. I've sorted these sectors in descending order so that your relatively stronger sectors are up here at the forefront. This is based not only on last week's price action, it does go back further than that so that you are looking for a slow movement, certainly from leadership names that might move down to this weaker quartile or the opposite, weaker names and areas coming to the forefront. So let's take a look. Up here we can see XLK, that's your technology ETF. And you can see that it is holding in certainly relatively well. It is up here at the forefront primarily due to a very strong January into the beginning part of February. And we can see that this week it was down certainly less than the NASDAQ. So it is holding in relatively well. It remains up here at the forefront after languishing down in this lower quartile for most of last year. Also up here at the forefront, consumer discretionary. That's going to be a lot of your retail related stocks up here at the forefront. Another area that had been quite weak again for a good part of last year. It remains up here despite being down over 4.5% last week. A lot having to do with two mega cap names, Home Depot and Walmart, that reported not just weak earnings, certainly for Home Depot, but also very cautious, and in Home Depot's place, a negative outlook going forward. So that really pushed these names down further. We'll get a closer look as we move forward. So from here, we also want to take a look at some of these weaker areas, be aware of them so that you're not overweighted. So this is an area I've been talking about for certainly many weeks here, and that is the healthcare sector. It peaked in price back here at the beginning of December and has remained under pressure for quite some time, and then this week now breaking below its last possible area of support at this 200-day simple moving average. Your momentum negative during this entire period for the beginning of this year. So as we move forward, I'll share with you one area that really pushed this index down even lower this week within healthcare, and also one other area that we want to be aware of that had been showing signs of life and really looked as if it might be on the move to the upside, and that is energy. It was down quite a bit actually this week. It was flat. Here's the price action for this week. But we can see overall net that it is in a downtrend, momentum negative on both that RSI and that MACD, and overall deteriorating. Next up, I'm going to share with you some really helpful ETFs that can help you stay on top of price action and what is driving the markets beyond those headline news. And here we are again at 2-month daily price chart view. One area that I will start with sharing is the price of Brent crude oil. You can see it declined this week, and that's one of the reasons that we are seeing energy stocks deteriorate. There are certainly other factors as well. We can take a look here, no further than the US dollar, which is really inching upward. This is UUP, and it was up almost 1.5% this week. And a rising dollar can be negative for commodities, certainly such as the price of oil. So as we move back, we can take a look at some of these other areas on the move. And in the forefront here, showing relative strength among these ETFs, is that yield on the 10-year. Rising interest rates are not good for the markets, and we can see that they are continuing to creep upward here, certainly since the beginning of February, which is dampening particularly high growth stocks. So as we move forward, you want to be aware of areas that are showing continued weakness. I talked about healthcare, and let's take a look. IBB, this is the NASDAQ Biotechnology ETF, and it was down over 6% last week. And this is one of the reasons that healthcare really took a bit more of a dive last week, and you can see the deterioration in biotech stocks. And these stocks are viewed as quite a bit more risky when you see a deterioration in biotech, as well as one other area I'll share with you that is indicating that investors are in a risk-off mode, and it does not bode well, certainly for the broader markets. Let's take a look at one other area that I mentioned is a proxy for sentiment, and that is small cap stocks. This is the Russell 2000 IWM, and it was down about 3% last week. You can see the momentum turning negative both on that RSI and then a downward trending MACD. So this is another area that really fared well, certainly in the beginning of this year, as investors were hopeful that we would see a nice continuation rally in the face of inflation, which at that time had been showing signs of being reducing. So let's go back to our list here and take a look at some other areas that are very impactful and that are on the move. And up here is volatility, VIX, or the fear index. And you can see that it ticked higher last week and remained fairly elevated. Rising volatility is not a good backdrop for the markets, and we do appear to be in a rising volatility environment. We will keep an eye on that. We're at about 21, almost 22, and ideally down in that 16 to 18 level for volatility indicates a market that is on firmer footing. So another factor not particularly welcome for these broader markets. So from here, I did want to share with you, I talked about consumer discretionary. Here's a quick look at the S&P 500 retail ETF, and it was down quite a bit this week. We talked about Home Depot and Walmart. There were other drivers there as well, with Tesla down 5.5%, and then Amazon down almost 4%. And those are certainly heavyweights among retailers. And this ETF was down almost 7% last week. So from here, with all of that news as far as the broader markets and where we stand, there was a question relating to ways that you could potentially get a little more defensive as a way to buffer your portfolio from the currently negative environment that is out there. So I'm going to share with you several consumer discretionary stocks, and these are companies that mostly provide products that individuals will need regardless of the economy, rising interest rates, and high inflation. So first up here is Hershey Foods. famous for their chocolates. HSY is the ticker symbol, and the company reported their earnings at the beginning of February back in here, and they did rally quite strongly. They showed 20% year-over-year growth, and it was 14% above estimates. We can see that the stock is remaining in a very nice confirmed uptrend while the broader markets are suffering. We also can see that the RSI is up here in positive territory, and the stock remains above this upward trending 10-day simple moving average. Your MACD up here in positive territory as well. And oftentimes these these consumer staple stocks offer a nice yield. Hershey is a 1.7% yielder. Next up, I will share with you a company that just reported earnings, and then another company in the same group that's due to report next week. First up here is Molson Coors Brewing. TAP is the ticker symbol. And we can see this gap up on earnings that took place on Monday of this week. Super big volume under accumulation. And then since then, the stock did pull back. But subsequent to that, we've seen a nice 3-day move upward. We also have positive momentum here with that RSI trending upward, likewise with the MACD. And the company did show 21% year-over-year earnings growth that was above estimates. And then also from here, I will share with you a stock that's in the same group in consumer staples that is due to report next Friday, and that is Anheuser-Busch. And we can see that the stock had a significant run up here. This was in response to earnings at this time, and more recently it has been mostly marking time, trending downward. This week, perhaps in response to Molson's strong earnings, the stock did rally. We are now above each of these key moving averages, which had been acting as resistance. We are currently above this 50-day simple moving average, and we did get nice volume on last week's rally, indicating accumulation. But another metric that really caught my eye is this MACD black line up through the red, that bullish crossover into positive territory. And when you see that take shape after a lengthy downtrending and then sideways movement, it often can bode well for nice upside if they do report strong earnings next week. We can also see that this RSI is in positive territory and trending higher. So last up, I will share with you a consumer staples name that also reported very strong numbers. So this is Clorox, CLX, and take a look. This is the gap up they reported over 2 weeks ago. Super big volume on that gap up, but the good news is that the stock pulled back very orderly to this upward trending 10-day simple moving average. It did not fill the gap here. That's good news. Also, the relative strength indicator up here remained in positive territory as the stock digests this really big move for a staples stock. We can also see that the MACD had that nice positive crossover, and it too remains in positive territory. Clorox is currently in a period, as you may recall, in that 2020 initial lockdown phase, they had huge growth numbers. And then subsequent to that, they are now coming upon some very low comparative numbers so that they could handily beat their same quarter a year ago earnings. So look for this continuation as we move forward into the remainder of the year. And then one other factor is that Clorox offers a nice 3.1% yield. I'll leave it at that. For those of you that haven't already, use that button below. You can trial my MEM Edge report. I will keep you very in tune to what's taking place in the market, and then also highlight what areas you should or should not be favoring. Have a great weekend. I'll look for you again here next Friday. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.